Imagine this. If you had invested just 1 lakh rupees 5 years ago, today that amount could have multiplied into 4, 5 or even 7 lakhs. Sounds unbelievable, right? But that's exactly what some of India's best performing mutual funds have delivered. The real question now is, are these funds still worth investing in or have they already peaked? In today's video, I'll take you through the 5 top performing funds, explain their categories and returns, reveal the key reasons behind their massive growth, and finally answer whether you should invest in them today, what risks they carry, and how you can avoid making mistakes. Top 5 best performing funds. Let's start with the stars of the last 5 years. At number 1, we have the Quant Small Cap Fund, Direct Growth. This is a small cap equity fund that has delivered an astonishing 50% annualized return. To put it simply, if you had invested 1 lakh rupees here 5 years ago, it would be worth more than 7.5 lakhs today. Next comes the Quant Infrastructure Fund, Direct Growth. As the name suggests, this is a sectoral or thematic fund focused on India's infrastructure space. Over the past 5 years, it has compounded at about 44% annually, meaning your 1 lakh rupees would have grown into over 6.5 lakhs. In third place, we have another fund from Quant, this time the Quant ELSS Tax Saver Fund, Direct Growth. Being an ELSS fund, it not only gave investors the benefit of tax saving under Section 80C, but it also delivered nearly 39% annualized returns. That's like turning your tax saving 1 lakh into more than 5 lakh rupees in just 5 years. The fourth on our list is the Nippon India Small Cap Fund, Direct Growth, another small cap category giant. This fund also delivered about 39% annualized returns, multiplying 1 lakh into more than 5 lakhs, largely by tapping into high growth sectors like defense, specialty chemicals, and manufacturing. And finally, rounding off the list is the ICICI Prudential Infrastructure Fund, Direct Growth. Just like the Quant Infra Fund, this one too focused on the infrastructure story and rewarded investors with around 39% CAGR. In simple terms, 1 lakh invested became about 5.2 lakhs. Why did these funds grow so much? So what explains this extraordinary growth? There are several reasons. At a broad level, India's economy has been expanding steadily at 6 to 7%, creating a favorable environment for businesses. The government's record spending on infrastructure, roads, railways, airports and defense provided a huge tailwind for infra-related companies. Meanwhile, the small and mid-cap segments saw a strong rally post-COVID, with many companies delivering multi-bagger returns. Another major driver was the surge in retail investor participation. With systematic investment plans, or SIPs, hitting record levels, there was a constant flow of money into equity markets, which kept liquidity high. Finally, these funds are not passive index trackers, they are actively managed. Their fund managers made bold and timely bets, often in sectors or stocks that were not the obvious choices at the time, and those high conviction calls paid off handsomely. Future of these funds, should you invest now? But let's look ahead. Can these funds continue to perform the same way? For the small cap funds like Quant Small Cap and Nippon Small Cap, the future still looks promising over the next 7 to 10 years. India's growth story is far from over, and small companies will continue to benefit from rising consumption, manufacturing, and exports. However, small caps are also notoriously volatile. A 20 to 30% correction in the short term is very normal, so they are best suited for aggressive investors who can remain patient and not panic at market swings. Infrastructure funds such as Quant Infra and ICICI Prudential Infra also look strong in the medium term, especially for the next 3 to 5 years. With the government pushing record capital expenditure and private companies restarting their capex cycle, there are opportunities for sustained growth. But infrastructure is a cyclical theme. If government spending slows down or if global commodity prices change, these funds could underperform for years. That's why they are better as part of a thematic allocation, not the core of your portfolio. As for the Quant ELSS Tax Saver, it remains a great option for those looking for tax savings along with long-term equity growth. But remember, ELSS funds come with a 3-year lock-in, and Quant's strategy is more aggressive than its peers, so be prepared for higher volatility. Risks and how to avoid them now. Before you consider investing, it's crucial to understand the risks. Small cap and infra stocks are trading at high valuations today, which means corrections are very likely. These funds can be highly volatile, and sectoral funds like infra are vulnerable to policy shifts or slowdowns in government spending. Quant funds in particular are known for taking concentrated high conviction bets, which makes them riskier compared to more diversified schemes. So how can you avoid these risks? First, don't put all your money into these funds. Limit your exposure to small cap and infra funds to no more than 20 to 25% of your mutual fund portfolio. Second, always invest through SIPs instead of lump sum, so you average out the volatility over time. Third, balance these high return funds with safer options like flexi cap, large cap, or index funds for stability. And finally, always match your time horizon. If you need money in less than 3 years, these funds are not for you. For a medium horizon of 3 to 5 years, keep the allocation small. For 7 to 10 years or more, these funds can indeed create significant wealth if you hold them patiently. So, what's the conclusion? Yes, these funds can still be good investments, but with caution. They should be part of a diversified portfolio, not the whole of it. They are excellent for long-term wealth creation, but don't chase past returns blindly. Be prepared for volatility, stay disciplined with SIPs, and invest only with a horizon of at least 5 to 10 years. If you found this breakdown helpful, do hit the like button, share this with your friends, and subscribe for more deep dives into mutual funds and investing strategies. And tell me in the comments, would you choose small cap funds or infra funds for the next 5 years? I'd love to hear your view.